$10,000 for gold, $200 for silver. Those are not today's prices, but they are the numbers now being openly discussed in institutional research, private bank briefings, and sovereign strategy circles as potential targets in the next phase of this metal cycle. A year ago, those figures would have sounded unrealistic. Today, they are part of the conversation, because gold and silver are no longer behaving like normal assets. As of early January 2026, gold is trading around $4,300 per ounce, holding close to record highs. Silver is trading in the $70 to $80 range, levels historically associated with monetary stress and tight physical supply. These moves are not driven by interest rate headlines or short-term speculation. They reflect structural forces that have been building quietly for years. Gold is increasingly being treated not as a hedge, but as a monetary reserve asset. Central banks around the world continue to accumulate gold steadily. This trend began more than a decade ago and has accelerated as confidence in fiat reserve systems has weakened. Gold carries no counterparty risk, no political alignment, and no exposure to sanctions or financial freezes. At the same time, gold supply remains constrained. Global mine production has been largely flat for years. New discoveries are harder to find, more expensive to develop, and slower to bring online. Demand is rising, supply is not. Markets adjust accordingly. Institutional investors are also beginning to move. Historically, large funds allocated just 1 to 2% of assets to gold. Even a small increase at that scale represents demand far larger than the physical market can absorb without major price adjustments. Silver's move has been even more aggressive. Silver is both a monetary metal and an industrial necessity. Demand from solar energy, electric vehicles, electronics, and advanced manufacturing continues to grow. At the same time, investment demand has surged as investors look for alternatives outside the traditional financial system. Silver markets are heavily leveraged. Paper claims vastly exceed available physical supply. When participants demand physical delivery instead of rolling paper contracts, prices move fast, sometimes violently. That dynamic is now clearly visible. Short-term volatility is possible. Mechanical trading, index rebalancing, and profit-taking can cause pullbacks. But those movements do not change the underlying structure. The broader backdrop explains why these targets are even being discussed. Debt levels continue to expand, fiscal deficits remain persistent, currency dilution is no longer theoretical. At the same time, global trade is slowly moving away from dollar-centric settlement systems. New payment infrastructure is being built. Gold is increasingly being used quietly as a settlement asset between states, not as a formal gold standard, but as a neutral anchor. This is not a sudden crisis, it is a slow repricing of trust. Gold and silver are not rising because something broke overnight. They are rising because confidence is being recalculated. The numbers may sound extreme, but markets don't move on comfort. They move on reality, and right now the signal is clear.